AI's comprehensive impact on financial services. There is no doubt that AI already has an enormous impact on the whole financial services sector. Besides AI's process automation applications, such as robotic process automation and cognitive process automation that helps to reduce costs, increase productivity, and prevent fraud losses, there is also a significant role for AI to play in digitized, personalized engagement as we see the growing internet user base swiftly switching to mobile devices to perform a transaction or related actions within integrated in-app transaction systems. As this would only increase the risks for cyber attacks and more possibly ways for financial fraud to occur, AI will also play an increasing role in assisting to address these risks. Mordor Intelligence has appraised AI's share in the fintech market as $7.27 billion in 2019 and projected it to get to $35.4 billion by 2025, with a compound annual growth rate of 31.5% for the period 2020 to 2025. Technavio reckons that the global AI market in banking, financial services, and insurance sector is expected to post a compound annual growth rate of 32% during the period 2019 to 2023. AI has broad applications across the financial services sector, from banking and insurance to investment, that advance better outcomes for both consumers and businesses. On the investment side, some relevant use cases for deploying AI solutions include maximizing investment, portfolio optimization, high-speed arbitrage trading, reducing compliance and regulatory costs, trade surveillance, abnormal trading pattern detection, market manipulation detection, and risk analysis and management. For commercial banking and insurance sectors, AI use cases include reducing credit risk through scoring and analysis, complementing traditional statistical scoring methods, churn mitigation, response modeling, real-time customer insight for personalized customer engagement, loyalty programs, recommendations, cross-selling, upselling, digital advice, Robo Advisors, fraud detection, smart payment systems, automated and augmented underwriting, and robo claims adjusting. Just between maximizing investment potential, reducing credit risk, and reducing compliance and regulatory costs, Goldman Sachs Global Investment Research, GSGIR, estimated that AI could conservatively enable access to between $34 to $43 billion per year in cost savings and new revenue opportunities by 2025, with further upside as AI enable faster and more complex data leveraging and execution. AI-driven software and hardware accelerators applied to the rich, high-volume, high-speed, and robust data sets are providing significant advantage to enable better informed investment decisions, quicker reaction to market events, reducing costs, and breaking into new profit pools. For example, to give asset managers at high-frequency trading companies a competitive advantage, execution speed and gaining access to trading information mere fractions of a second before the market through co-located trading servers at the exchange and or sourcing data from raw exchange feeds and retrieving best bid offer prices faster than traditional data consolidation processes are paramount. Fast executing AI algorithms can use this latency arbitrage to act on the price spread in a faster and more accurate fashion before the latency period has elapsed. These AI-powered algorithmic trading solutions can also use alternative data such as geospatial, for example, satellite imagery of areas that are relevant to equities, commodity prices, or even economies, social media sentiments, for example, blogs, reviews, brand logos, web metrics, Facebook, Twitter, Instagram, TikTok, LinkedIn, YouTube, and Sina Weibo, and credit card transactions to complement the typical pricing signals, company performance metrics, and news sentiments to help optimize investment portfolios. A complementary AI use case is where image recognition machine learning techniques, such as convolutional neural networks, are used to extract key characteristics from real-time satellite imagery of commodity depots, storage facilities, production facilities, containers, shipping movements, store parking lots, agricultural land, etc., which in turn can be used as additional input features to models of AI-driven trading solutions. For example, A retailer's sales can be predicted by, amongst other factors, using features extracted from real-time imagery of store parking lots and shipping patterns. In general, the financial services industry has a great opportunity to benefit from AI being applied to data-driven market events, as also illustrated by the volatility around data releases in the commodity futures market. Hedge funds and other asset managers can also save costs by reducing labor needs at a faster rate than the growth in data procurement costs, where a 5% reduction in operating expenses is predicted for the asset management industry, implying a $13 billion annual cost reduction by 2025 for the industry. Given new regulations that are facing the banking industry, there is also an increased compliance spend by small community banks, commercial banks, as well as large investment banks, as reported by the likes of JP Morgan, Citigroup, and others over the last decade, resulting in an estimated total of approximately $18 billion in compliance-related employee costs per year. AI can be used in a proactive fashion to handle tasks such as detecting violations, for example, such as unauthorized trading, market manipulation, or wall-cross violations, as well as inspecting employee emails for potentially non-compliant content. A 10% reduction in compliance employee costs because of AI-driven solutions should therefore contribute approximately $2 billion per year in compliance cost reduction for banking within the next few years. As another example of reducing cost through process automation, JP Morgan has introduced an AI solution called Coin to review and interpret commercial loan agreements in seconds, which has eliminated more than 360,000 hours of work for lawyers each year. Intelligent virtual assistants deployed within the banking sector and powered by social messaging platforms, mobile devices, or voice assistants can help to provide much better customer service through its convenience, ubiquity, and ease of use to allow customers to quickly inquire about accounts balances, mortgage options, or other banking services. With state-of-the-art natural language process capabilities, personalized intelligent virtual assistants that are integrated with banking systems and related data can not only process customer queries asked with significant variations, including spell and grammar errors, and handling the context of the user interaction, but via text or voice command provide quick answers to banking queries, personalized financial advice, and even carry out transactions all from the same channel. Also, amongst the emerging trends are AI-based Robo Advisors that calibrate financial portfolios in accordance with the goals and risk tolerance of their users with respect to investments, trading, loans, and retirement plans. This can be achieved by optimizing how investments are spread across asset classes and financial instruments and adapting in accordance with real-time changes in the market, as well as the user's goals and objectives. These AI-based robo-advisors allow users to create individual, personalized settings for their preferences regarding investment styles and associated risk management, and also leads to fewer human errors being made and lower transaction fees. For the general banking sector, there are also opportunities to reduce costs and increase revenue by applying AI to their own vast, comprehensive, proprietary financial data in combination with external data sources. These data sources that are typically in silos and not always easy to integrate include, for example, core banking data, customer data, product data, customer information file, payments data, mortgage data, social network data, market data, reference data, email data, messaging platform data, omni-channel data, smart device data, external agency data, tax, regulation, compliance data, ATM kiosk data, online and mobile internet data, customer services data, and trading data. In order to operationalize and automate AI-driven solutions, rapid access to all available structured and unstructured data is needed to generate insights and a 360-degree view of the customer, portfolios, risks, and exposure. This in turn feeds next best actions with respect to the bank's core back-office processing, risk management, governance, and compliance, as well as sales and services, marketing, and customer and product management. One of Cortex Logic's AI use cases for a major bank involved the delivery of AI-driven models to optimize the price of home loans in a dynamic and personalized fashion. This is an example of a high-value business case, as a percentage increase in home loans market share, even in South Africa, is in the order of billions of rands. In the US alone, the total amount of home mortgages was around $10.5 trillion in 2019. The Cortex AI solution mines structured and unstructured data for better segmentation and improved real-time and personalized price positioning for home loan applications. We see a similar picture evolving for insurance sector businesses, where AI applications, data mining, and real-time analytics can be customer-centric, risk-centric, or finance-centric. As it is in the case for banking, the AI solutions focus on insights generation and next best actions with respect to delivering the right offer to the target customer at the right time to the right locations via contextualized, personalized, and dynamic decision recommendations, managing real-time customer interactions through integrated channels, offering highly tailored and differentiated product and services, and updating customer services representatives with the right profile and preferences. Customer insights can be further enhanced via geospatial overlay and alerts, real-time risk analysis across portfolios, and identifying communities, leaders, and followers. Other real-time analytics can involve focusing on customer retention, loss reserve and portfolio analysis, fine-grained risk analysis, fraud detection, channel preference, and social style-induced segmentations, brand or reputation monitoring and analysis. The insurance industry has rich data that includes customer information, call center, leads, claims data, policy management, vehicle usage, social network data, telematics data, agency data, location data, trading data, rate-making data, customer life stages data, billing data, channel interaction, and prospects. Some specific AI applications that are providing insurance businesses with a competitive edge involves redefining the value proposition via personalized customer experience, redefining distribution via digital advice, enhancing efficiencies via automated and augmented underwriting, and reducing claims processing time and costs via Robo Claims Adjuster. To create improved personalized experiences, natural language processing is applied to do text mining, topic modeling, sentiment analysis of social and interaction data. Machine learning is used to infer behaviors from data. Audio and speech analytics is used to better understand reasons for a call and emotion of callers. And agent-based simulations can be used to model each customer and their interactions. An AI-driven digital advice solution not only involves natural language processing, but also predictive models on when customers need what products based on life stage and life events, helping advisors to identify the right tax advantage products, monitor behavior, spending, and saving patterns, and agent-based modeling for cradle-to-grave life events and facilitating goal-based planning. To provide automated and augmented underwriting, predictive models are used to assess risk. Underwriters are supported in looking for appropriate risk attributes. Home and industrial IoT data are used to build operational intelligence on risk drivers for machine learning models. Process mining is used to automate and improve efficiencies, and deep causal models of risk in product lines uses system dynamics. The underlying AI technology to build a Robo Claims Adjuster involves claim predictive models, determining repair costs, automatically categorizing the severity of vehicle damage, and the use of graph and social networks to identify patterns of fraud in claims. It also includes the mitigation and reduction of losses by using home and industrial IoT data to build operational intelligence on the frequency and severity of accidents, identifying bottlenecks, and improving efficiencies and conformance with standard claim process, and the use of deep causal claim models using system dynamic and agent-based simulation techniques, and link them with product and distribution risk. One major AI use case for both banking and insurance industries is smart risk scoring. Amongst the many different types of risk applications, the most common ones are typically where credit risk and claims risk are prime examples. The traditional logistics regression type of risk scoring, which provides transparent logic and represents industry best practice in credit scoring, can be augmented and enhanced with machine learning-based approaches to address limitations such as its inability to identify nonlinear relationships between variables. In an augmented approach, machine learning can be utilized to expose powerful and predictive new latent features of credit risk, which can be used to enhance logistic regression models. A shortfall with this approach is the potential difficulty to explain the machine learning-based segmentation and relationships between variables. Although machine learning approaches such as neural networks, random forests, and support vector machines are perceived as black box techniques that needs to be adapted to create trust and transparency, they are being utilized within the banking and insurance industries to deliver enhanced performance to provide non-linear and non-parametric forecasting and classification. These techniques can also create dynamic self-learning models that can cater for subtle hinges in credit behavior. For these types of approaches, model risk governance needs to be redefined as it is exceedingly difficult to validate these models if it is constantly changing. AI can also be used to identify risk in revolving lines of credit and execute limit reductions on forecasted credit delinquencies. Creditworthiness can also be determined beyond the use of typical metrics for non-revolving consumer loans using machine learning advances to better inform and determine patterns in fraudulent activity claims and transactions. In some financial applications, such as microlending in the emerging markets, where credit history or risk-related data might not be available, the risk profile of a customer can, for example, be inferred and updated using data from their mobile wallet and call direct records. We have done this successfully at one of the companies that I was involved in called Jumo, a fintech company providing a full technology stack for building and running financial services in the emerging markets. It has shown that the predictive power that can be generated from event-level data far surpasses that which can be generated from aggregated data, resulting in much more effective models and decision strategies. This is because the high-resolution data allows creation of potentially hundreds and thousands of features to which the predictive models have access. As the market evolves and as customer behavior adapts, it is important for machine learning-based solutions to have a wide variety of signals from each customer to learn these changing behaviors and how these affect credit risk, product uptake, upsell, cross-sell, and other customer responses. In another AI use case, one of the leading insurance companies in South Africa needed to improve their customer service whilst reducing the high cost and time-consuming nature of manual processing. The problem was that their service center had to manually process thousands of emails daily, which is a resource-intensive task that involves many dedicated employees and is expensive in terms of time, cost, and human productivity spent on low-value tasks. The manual processing by the call center staff involved understanding the intent, examining the attachments, and assigning it to a processing queue. Cortex Logic developed specific AI solutions called AI Email, AI Audiobook, and AI Assist to automate the handling of incoming customer communication. The AI Email solution classifies and groups incoming emails for further processing and data extraction to improve business function and reduce operational load. Besides understanding email content through intent recognition and categorizing it with a confidence score, it handles multiple languages and provides sentiment analysis. The AI Audiobook solution extracts data from any document with minimal configuration, understands data relationships such as questions and answers, as well as recognizing alphanumeric handwritten text. The AI Assist solution routes the text comprehension and confidence score for action, which involves further automated processing, such as creating an entry in a customer relationship or ticketing system, pre-populating key entities, and assigning the outputs to robotic process automation of back-office system, or manual processing of outlier cases by a services desk agent. The prediction and mitigation of churn, i.e. the loss of customers to competition, is another key AI application area for most consumer-facing businesses across multiple industries because it is more expensive to acquire a new customer than to keep your existing one from leaving. Most consumer-facing businesses suffer from voluntary churn. The churn rate has a strong impact on the lifetime value of the customer because it affects the length of service and the future revenue of the business. For example, a business with a 50% churn rate has an average customer lifetime of 2 years. Similarly, a business with a 20% churn rate has an average customer lifetime of 5 years. Consumer-facing businesses typically spend significant money to acquire a new customer, and when that customer leaves, the company loses both the resources spent to acquire that customer and the future revenue from that customer. Churn can be reduced by using machine learning-based approaches to predict a customer's propensity to churn by using customer-specific information that includes household, transactional data, and behavioral data. Machine learning can also be applied to a related problem of lapse in payment or non-activity, which can lead to churn or non-active customers. So machine learning-based models that predict a customer's lapse propensity or non-activity could be used in proactive mitigation strategies. In one of the use cases, a leading insurance brand in the call center market experienced a 40% cancellation rate of all their policies issued within 90 days after the sale. A churn prevention solution was developed using a variety of customer data sources such as email correspondence, voice recordings, text interactions, and demographics. The proposed sale was then analyzed and the price adjusted to reflect the risk and or reject the sale the next day before the bulk of the costs relating to the issue of a policy is incurred. This leads to significant cost savings for the insurer. In another AI-driven churn prediction use case, a solution was implemented to predict lapse propensity and non-activity on a funeral policy insurer. The datasets consisted of funeral policy data for main members and dependents, as well as the payment transactions. Apart from accurate predictive models that generalized well on unseen test data, insightful analysis was also provided, such as the average probability to lapse by age, gender, plan brand, plan premium, etc. In a mobile money use case, a reduction of churn and improved customer loyalty was ensured via the use of predictive churn models and increasing mobile wallet activity with attractive personalized product offerings. Data mining that provides real-time customer insights, segmentation, and social network analysis can act as a fundamental building block of derived customer insights and features for other AI use cases that contribute towards a 360-degree view of the customer, where structured and unstructured data is mined. Natural groupings is detected in the customer data via unsupervised clustering techniques as part of a segmentation analysis, and customer interactions and community structures are analyzed utilizing information about connections between individual customers. These valuable insights are also used as derived features in other customer-centric AI-based applications, such as risk scoring, affordability scoring, fraud and anomaly detection, response prediction, recommendation engines, and churn prediction. In many applications, models developed on segmented data sets allow for more accurate results than ones that are generalized over a single non-segmented customer data set. For example, for credit risk, we see a segmented scorecard typically outperforms a single scorecard. Segmentation analysis is dependent on the types of data available and is typically focused on a combination of demographic, geographic, and/or behavioral segmentation. In turn, this can feed into more specific types of segmentation analysis, such as market segmentation or risk segmentation, where aspects such as stability, willingness, and affordability are relevant. In financial applications, demographic segmentation typically utilizes know your customer data and can, for example, be further enriched by adding mobile network event level data that allows for richer geographical information through the knowledge of tower usage. Behavioral segmentation can, for example, be used to identify groups differentiated by value, volume, and product usage. Transaction data enriches behavioral segmentation substantially by enabling the calculation of additional features which speak to the particular way in which the customers use their phones, wallets, and related services. Some example features include proportion of data usage in business hours, proportion of messages sent to core contacts versus non-core contacts, proportional overlap between calling partners weekdays versus weekends, variation in airtime balance as at time of top-up, etc. If these types of features are tracked over time, it enables the development of perspectives on customer lifecycle and maturity and associated opportunities at various points in this lifecycle. Related to this is the ability to identify different trajectories. For example, if a customer displays a certain behavior type this month, what behaviors can we expect with what probabilities next month and the month after? The type of analysis also allows the measurement of segment size at a portfolio level over time and the identification of emerging submarkets. Social network analysis focuses on customer interactions and community structures, which are analyzed utilizing information about connections between individual customers. As an example, changing phenomena within the market tend to propagate through the community structure. A particular behavior might originate in one section of the community and spread to others. By understanding how the community is structured, one can anticipate how long it will take for each trend to reach different sub-communities of customers. A prime example of this is the adoption of new products, as often this is driven by word-of-mouth referral. As an example, social network analysis that utilizes mobile network event-level data makes it possible to see individual connections. The transactional level data allows for creating various graphical representations of customers. Some use cases for insights from social network analysis could include detecting lending circles, syndicated schemes, and fraud rings, as well as profiling of individual customers based on their social interactions. As with other industries, the financial sector can benefit significantly from machine learning-based security systems that can identify and detect potential illegal access points to a financial institution's data or funds, anticipate how money laundering or fraud can be committed, and provide real-time preventative solutions to stop these crimes before they happen. From a detection perspective, the accurate identity of an individual or fraudulent actor is determined through a combination of machine learning-based models, scoring, and rules. Machine learning-based approaches are starting to be preferred above a pure rules-based approach, as there are a need for scalable and computationally efficient prediction models that make use of information from multiple attributes at the same time, increase the detection accuracy, which can lead to significant savings, model complex attack patterns not previously observed, and combat fraudsters, which are becoming increasingly smarter and adaptive. Supervised machine learning models that learn from past examples of fraud are typically used to predict fraud in real time, whereas unsupervised AI methods that segment transactions and/or do anomaly detection can be used to potentially discover new fraud. Depending on the specific scope and application, fraud detection models can, for example, be deployed on a transactional, account, and/or network level. On a transactional level, AI models can flag fraudulent behavior upfront and also help to provide an in-depth analysis after transactions are completed. On an account level, abusive behavior such as frequent payments or suspicious profile changes can be identified, whereas on a network level, account-to-account interaction such as frequent transfer of money from several accounts to one central account can be identified. Where relevant, intelligence from past discovery and investigation processes are also used to recognize fraudulent activity patterns and highlight potential payment submission improprieties for further investigation by the investigation team. To discover fraudulent patterns, a rich set of AI capabilities is leveraged to identify non-compliance by retrospectively reviewing historical data, analyzing patterns and anomalies to identify individuals or organizations that might be developing fraud schemes. These predictive analytics can be complemented by prescriptive analytics that takes the predictions made from the correlations of a predictive analytics engine and uses it to provide recommendations for what to do once fraud is detected. Other aspects of comprehensive fraud detection and prevention solution include quick response to criminal activities, intentions, or patterns, as well as proper investigations into suspicious activity that will support the compilation of evidence and provide the thorough analysis required to build more compelling cases for denial of payment, recovery, or prosecution.